Hey guys, what's going on? I hope you're having an awesome day. We're back with another episode of YouTube Stock Portfolio. This is episode 5, and we're going to continue off from last week where we were just going through and analyzing the stocks and getting our shortlist down to a few that are going to be really successful businesses, and maybe we will invest in one of them. And last week we started off with Ford, and we had a bit of a look through, and I've basically just labeled it as yellow on our spreadsheet because the numbers aren't great. I think we'll probably find some other companies with better numbers, but it's not one that we're going to reject right away because it's not too bad. But yeah, let's go and have a look into some of these other stocks. And I just want to apologize for not being on camera for this video. I've been a little bit sick, so I didn't quite feel like getting the camera out for this one, but I will be back next week. I'm going to make this video a little bit longer than usual. I might make this go for 20 or 30 minutes. We'll see how long and how far we get, but let me know if you like that longer format. Just let me know down in the comments section, and I can adjust this series however you guys would like. But let's go and have a look at IHG. So it's the next one. Intercontinental Hotels Group. Alright, so at a glance, I can see that revenue growth has been pretty much non-existent over the past 10 years, and you can see that they're actually flat since 2011, and they've been down since 2013, which is really not a good sign. If we have a look at EPS, we can see that, again, EPS has basically been flat. So straight away, I know this is not a business that I'm going to be interested in because we're looking for businesses that are growing at least or around 10% per year that have that kind of growth prospect in them. So let's get rid of IHG and move on to Wyndham Worldwide. Alright, so wow, okay. So Wyndham Worldwide in 2012 had revenues of 4.5 billion. This year they did only 400 million. Wow. That is a drastic decrease in revenue. That's really not good at all. I was hoping one of these hotel chains would be a really good company because I find that it's an interesting sector, but there's nothing here. Earnings per share, it's been very good, actually, in the last 12 months. They took a loss last year. It's just all over the place. You can see I'm just not interested in stocks like this. Goes up from $1.44 to $2.20, and then big negative. Then it goes up again a little bit, and then almost negative, pretty much zero. Big, zero, like... It's just not consistent. There's no way we're going to be able to predict where this company is going in 10 years because look at how inconsistent their earnings are. So that's another one that I'm not interested in. So I just remembered that Wynn Resorts was quite a successful business and it's quite a big business. I thought maybe we'd just have a look at that one. And their revenue growth has been 9% over those 10 years, or since 2009 at least, which is very good. Their earnings per share growth has been 12%. So they've got some good numbers there. It looks like their ROIC is quite low, and they do have quite a high debt to equity ratio, so it might not be a company that we're interested in, but I'm just going to put that to the side actually, and towards the end of the list, if we don't have any, we'll have a look at that one. Alright, so next up we've got Coca-Cola, KO. Yes, this is a massive company. This is a $200 billion market cap company. And companies like that, they're generally not going to be growing very quickly. And that's probably what we're going to find here. And yep, since revenue has been flat since 2010, and it's actually been declining since 2012, 13, 14, 15, 16. It's just been on a straight decline down. So that's not good. It says here that earnings per share has been negative 13% per year, which is insanely bad. That's not what we want to see. So again, just not interested. I'm just going to cross it off, and we'll have a look at Pepsi. PepsiCo. Alright, so Pepsi, a little bit better. They've been growing revenue at 5% per year, which is not too bad. And what's their earnings been like? Earnings has been flat. So again, not interested in a company that has flat earnings. It's just not growing quick enough. Next, we've got Apple. And Apple, of course, has had amazing growth over these years. And I've actually already analyzed it, so I'm just going to get that spreadsheet out in a second. But at first glance, we can see revenue growth 25%. That's amazing. EPS growth at 32%. Insane again. Free cash flow at 30% and assets at 30%. That is all really amazing. ROIC at 40%. That's insane. That's very good. And then we can just have a look at the multiples to see if this high growth is going to translate to a stock price being extremely overvalued, having a PE of maybe 80 or something, but they actually only have a PE of 20, which is not too high. So I'll just get out that spreadsheet. All right, so here's that spreadsheet for Apple when it loads up. Oh, and guys, if you're new around here and you haven't seen me before, you can get access to this spreadsheet and it helps you analyze the growth numbers and what return you can expect to get. You can get all of that linked down in the description below. It's completely free. And yeah, it's just really helpful. I thought you guys might want something like that. So if that's something you need, go and grab that, and then you can sort of... I also have a video teaching you how to use it, so you can check that out as well if you're having trouble understanding how Google Docs works. But anyway, so for Apple here, I've got the ROIC actually a bit lower at 25%, so maybe this website's wrong or maybe it's right and it's stronger, but we'll just be conservative and say it's in that 20% range, which is still amazing. If we come over to their growth numbers, so what we can see here is their growth has been strong over the long term, but it's been getting worse, their growth. Not that their performance has been going down, they haven't been negative EPS or anything, but the rate at which it's growing is slowing. And that's to be expected from a company as big as Apple. I spoke about this in my Apple analysis video actually that I released a week ago or so. So go check that out if you're interested in that. But essentially these 7 and 9 year growth numbers are representative of when they brought out those two really innovative products, which was the iPod in 98, I think it was, and the iPhone in 2007. So both of those were really amazing products that revolutionized how we listen to music and then how we communicate to each other and smartphones and that sort of thing. And that allowed them to grow at such a rapid rate over the last 10 years. But in recent times, they haven't been able to innovate as much as they did for those two products. So we've seen that their growth has sort of stabilized at a lower level down here. So you can see that it's come down from these highs of 20 and 30, and it's sort of, in the last 5 years, it's been quite flat here. Especially the EPS has been flat, and the sales and the equity has been in that sort of, 5 to 10% range of growth. So that's the growth that we would want to be using if we're projecting out into the future using Apple. We definitely don't want to use 30% or something like that, because it's just not what they've been experiencing over the last few years. And we could use a growth like that, and maybe they will perform like that in the future. Maybe they'll come out with another really, really powerful product that sends them back into this 30% growth mode. But I think that it's a bit too risky to assume that they're going to be able to do that. I think we should assume what kind of growth they've settled at over the past 5 years. So I actually really like Apple's growth numbers because while it has been slowing down over time, they've clearly demonstrated that they've got a moat, and the fact that their numbers have slowed down, but they've started to be consistently at this level again. I feel like that's much better than if it was just a continual downward spiral that was continually getting worse and worse every year. Like, for example, for sales, instead of it going 24, 19, 7, and then 7, 7, imagine if it had gone 7, 4, 2. That would be a horrible sign. That would mean that I don't think that they have a moat anymore, and that they're heading in a direction that we don't want to be going with. So we definitely wouldn't want to be investing in that company. But because it's stabilized, I'm quite confident in that. So that basically ticks. So for Apple, circle of competence, we can have a look into it and understand how the business operates and their different, the different parts of Apple's business and their services and their software and that sort of thing. But essentially, we could say that that's covered Moat, I would say that moat is most definitely covered. These numbers show that their moat isn't as powerful as it once was. It's not a moat that's going to be able to protect themselves at 20-30% growth, but it seems as though they've been able to stabilize at a 7-8% growth rate that they should be able to maintain over the next few years. So I think it ticks the moat box. And then of course we need to have a look at management, and we need to see if management has skill and integrity. And the areas that I look at two areas. One, I see capital management, which means how are they investing within the business? So they obviously get money from the previous year and that sort of thing. How do they take that money? What investments are they making, and what return are they getting on those investments? And that's what we want to see, if they're effective at doing that. And if we go have a look, as I just mentioned, the ROIC was either in the 20s or the 40s, depending on which website you use, but let's just say 20 for now. So they're able to get a return on their capital inside the business of over 20%, which is incredible. It's really, really good. One negative sign I will mention is that their ROIC is slowing down from 25% to 22%, which is not what we want to see, because we don't want that trend to continue, and then turns out in a couple of years' time they're investing at 8% instead of up in the 20s. But they're both pretty close together, so it seems as though they're pretty consistent at what rate they can invest in, and that number is above 15%, which means that we as shareholders can be confident that we were going to be able to get 15% from the stock price if they're making 15% on their internal investments. So then, of course, as I just mentioned, we want to check how they're managing their debt. And I use two ratios to do this. I use the current ratio, which looks at the assets and the liabilities that are being converted in the next 12 months. I like to see this number over 2. So 1.3 is a little bit low. And then we have the debt to equity ratio, which compares how much debt is in the company to equity. And I like to see this at below 0.5, and theirs is at 1.8. So they have a little bit too much debt for my liking, but it's not horrible, and we'll definitely keep this on our list. And basically what I'm going to do here is we're going to go through and look at the first 3 checklists and tick these off for as many businesses as we can. And then with the ones that are left, we'll go on and do a valuation and see what margin of safety we can get there. So I'll give Apple a green highlighter because I think it looks very good. And let's move on to let's move on to Amazon, and let's have a look. So Amazon, amazing growth as well as Apple, 30% growth or 28% growth in revenue, almost 20% growth in earnings per share over the past 10 years. This is free cash flow growth of 20%, which 22%, which is really amazing as well. And it looks like they've got a low debt to equity ratio as well. So this is definitely going to be a business that I'm interested in. So let's go ahead and chuck these numbers into our spreadsheet. All right, so I just went ahead and entered in all of the numbers for the 4 things that we look at for the past 10 years. And let's have a look at their growth. So lots of green, which is a good sign. And of course, that's to be expected by a company that recently hit $1 trillion market cap and then fell down a little bit, but it's up there with Apple. And if we have a look at their sales, so this is pretty much exactly what we want to see, a number above 10% on the 9-year average, and then each year getting stronger. So it did drop down for these 2 here, but overall that trend is a positive upward trend, and we can see that on the sales on this red line in the graph down here. We can see that it dipped a little bit, but generally it's pretty stable and it's a strong trend. If we have a look at earnings per share, same story. 17% is above 10% easily, and then every year drop down to 14 there, and we don't have these numbers because there's some negative numbers here. So that's what's going to happen in your valuations. If we have negative numbers there and there, then we're not going to be able to calculate the growth over that period. But that's also got an upward trend, which is a good sign. Equity growth, this is the one I like to watch quite closely because it's important. Equity growth being the growth of the book value, the core component that is basically the intrinsic value of a business. Again, 30% over the long term, easily above that 10% requirement, and each and every year growing with 44% equity growth in the last year. That's pretty insane. That's really great. Free cash flow, over the long term, 25%, it's good. 84% over the 5-year average, wow. Okay, 62% and negative 20% this year. So we'd want to have a look and see why they had negative free cash flow growth this year, in the last year, because we want to know if that's going to be a trend that's going to continue or whether they just did some one-off investments that are not going to affect their numbers again. But these numbers are amazing. They're probably some of the best numbers I've ever seen. I've only seen better numbers in, I think Thor Industries has better numbers, and I think Lamb Research was another one that I analyzed, had amazing numbers. They were all green, all perfectly correlated, and all moving up together pretty consistently, which was amazing to see. But now that we've done that, so like basically meaning, yeah, that's an area that I would struggle with Amazon because it's got so many components. It would be difficult to understand all of them completely. So if for my personal portfolio, it probably wouldn't be one I would go after, or if it was, I would do a ton of research before I went and invested in it. But for this series, let's just assume that we've ticked circle of competence. And in terms of moat, I think we discussed that it had a qualitative moat already. Everything on this list basically has a qualitative moat. In a quantitative sense, can we see that it's backed up in the numbers? I think clearly yes, and I think that anyone with half a brain can see that Amazon has a huge economic moat, and of course, as we just said, it's backed up in the numbers, so it's confirmed. Now let's have a look at the management. So we need to have a look at their ROIC to see their capital management, and then those two debt ratios. So first, let's go find that ROIC. So I always get the ROIC off MSN Money. I think it's just an easy place to get it. So I just search Amazon, MSN Money. And then if you come over to the Analysis tab, click that. And then scroll down Management Effectiveness. And this will give you your ratios. So their 5-year average is 4, which is really low. But it is in line with the industry average, which is very interesting. And then we can see that their return on capital for this year was almost 16%, which is easily double the industry average. So clearly that 4% isn't too much out of whack from what the industry expects. And then that 15% is way above what the industry average is. So that's actually a very good sign to see. And I'd like to see a trend of their ROIC over time, each and every year, not just the 5-year and the 1 year, to see if this is just a random spike or if it's a consistent trend that they're just growing that ROIC and getting more and more effective over time. But let's enter those numbers in. So for the 1 year, we've got 15.6 something. That'll do. And this was 4%. Yeah. All right, so then we need to get the average PE ratio for Amazon, and I like to use Y charts because it's easy. Just says it right here. So they've got an average of 420. Now, there's no way I'm using that as my PE ratio. I'm going to use something much more conservative because that's just insane. I'm not using 1400. So what I've got in here, what have I got in here at the moment? 15 to 80 and then a 40 in the middle. 15 might be a little bit too low. Yeah, if I bring that up to 25 and I do 100 and then a 50 or something like that. Nah, that's not exactly, that doesn't make any sense. Let's make this 65. So, let's do 50 and 75. So we're saying that in 10 years time or in 5 years time, whichever one we use, they're going to have a PE of 50, and maybe the PE will be as low as 25 and as high as 75. And I think that's really high to assume. I really wouldn't assume that if I was making investments for my personal account, because it's just a huge assumption. And the only reason that I'm keeping it that high is because they currently have a PE of 200. So I don't want to be too low, and because if I use the market average being about a PE of 15 over the long term, then we're talking about, it's just too low. It's just too low for this stock and for how much they're growing at. So I think that's okay. And then let's do these debt and equity ratios. So for them, we just need to fill in current assets, current liabilities, and total liabilities. So go over to the balance sheet. Current assets is 131,310. Their current liabilities. Oh, actually, sorry, that's total assets. My bad. 6197. And then current liabilities of 57,883. And oops. And then total liabilities of 103,601. Okay, so we've got a debt to equity ratio of 3.74, which is really high, way too high for my liking. Although, I will just mention, since they've been growing equity so quickly, we'd have to have a look, but I doubt that they've been growing their debt that quick. So it means that this debt to equity ratio will be coming down quickly, and that's the trend that we want to see. We want to see that debt to equity ratio coming down, not going up. Their current ratio is 1.04, which is okay. They've got enough current assets to cover their current liabilities, but it's not above 2, so it's not amazing. Yeah, so I'll give this one a green as well, because it's pretty good, and it's better than Ford. Ford was not that great. We'll probably end up getting rid of Ford. So the next one we've got is Activision Blizzard. This is a gaming company. If you don't know, they make video games and that sort of thing. Video game developer, I think, is their title. Okay, so revenue growth has been 9.2%. That's great. Earnings per share growth negative. It's a shame. Free cash flow growth is good, and their asset growth is good, but that earnings growth being negative, it's not great. Actually. Ah, yes, I see. So they had a few bad years, and it's just all over the place. Again, I just don't like it. I don't want to see it. I don't want to see going up, and then bang, huge loss, and then yeah, it's just no. So it's a no from us. Next, we've got Google, and I'll just pull up the Google spreadsheet because I've already done it in my own research. Oh, I actually haven't put in all of the numbers. Actually, how many numbers does Google have? Do they even have 10 years of data? Wow. Okay, Google doesn't have 10 years of data. Okay. So we've got from 2012. Do they have 2018 yet? No. Okay.
These came back from a search.
I don't know if you just heard that, but because we were speaking about Google, I accidentally set off my Google Assistant. So I'll just shut that up. Sorry about that. But yeah, so we've got 5 years of data, and we can have a look at their growth numbers. So we can see that, okay, sales, good long term, or 5 year at least, and they're growing each and every year, so that's good. Earnings per share, same story, good. I don't know why these are yellow, they should be green. Equity growth has been slowing, which is not a good sign, and free cash flow growth is a bit all over the place. So not fantastic, and we don't have 10 years of data, so we definitely can't look 10 years into the future. This would be a sort of a speculative play because we don't have 10 years of data, so we can't be super confident in where this company will be in 10 years. So I'll put that as a yellow, and we'll move on to Shopify. Okay, Shopify, a big no. Let's have a look. So we've only got, again, only 5 years of data. Revenue has been growing, but they're not profitable. And that's a big no from me if they're not a profitable company. So Shopify is definitely one that we couldn't invest in and get completely behind. We could invest in it as a speculative. That's another interesting thing. So if you want, I could have some speculative positions in this portfolio. I might have one or two that's like 5 or 10% of the portfolio. So let me know what speculative stocks you're watching and you're interested in, stocks that don't have the track record but you think has high growth potential. Let me know some stocks down in the description below, not in the description, in the comments box below, and I might add some of those to the portfolio, or one of those to the portfolio anyway. Alright, so I just checked my timer and I've been recording for almost 30 minutes now, so that means the video is probably going to be about 20 to 25. So I'll leave it there for today, and next week we will continue and have a look at stamps.com and sketches and finish off our shortlist and bringing that shortlist down to a few stocks that we're really interested in. And then we can go through and further analyze those businesses, do some valuation on them, see what return we can expect to get over the next 10 years if investing in these companies, and we can see which ones are going to make it into our portfolio, which is really exciting. That's an episode that I'm excited to bring out. And I'll also be bringing out a portfolio update video for this series probably next week or the week after. And just letting you know how the stocks in the portfolio are performing. Even though short-term news isn't too important, it's interesting to keep up to date with it. And if you're interested in my personal holdings, I just brought out my portfolio video where I talk about my holdings and how they've changed and any recent trades and that sort of thing. So if you're interested in that, go check that out. But for now, guys, I will see you on Tuesday when I bring out my next individual analysis video. So until then, I hope you guys have a great day, and I'll see you in the next one.